Hi, guys, and welcome to the 17th episode of the weekly trading wrap up, where we talk about the week in markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Okay, another devastating week. It's all about tariffs and Trump, of course. As usual, we're going to start with the S&P 500 daily chart, and this arrow denotes the week. Monday, Tuesday, Wednesday, Thursday, and a relief rally on Friday. Okay. This week started off very badly because over the weekend Trump sounded like he didn't care about the market. Okay. So it was a gap down open, and we spent the whole week below what looked like a promising Friday of last week. Okay. So right off the bat, let's just talk about the technical picture. Okay, we're going to start off by always talking about the technicals and how it relates to our overall view. Okay, so the technicals last week looked pretty good. Okay, this was Friday of last week, this green candle, and it held above this key support line you see going back to July of 2024. Okay, but Friday just on Monday, we just ripped through that like a knife through butter, and for the whole week, we stayed below this level, okay? And if I put up the moving averages, you can see that we're trading below the 200, and that's a technically bad place to be at, okay? And we haven't traded below the 200 for a long time. And as you see, this was the 2023. You can see that trading below the 200 when we're in a bear market like here in 2022, you stay below the 200 for a long time, it's bad. Okay, the moment it goes above the 200, good things start happening. Okay, you can have little peaks that go down, but if you stay here for a long time, it's not a good picture. Okay, so we don't want to stay below the 200 for a long time. Okay, we want to actually recover. Okay, otherwise it'll serve as resistance. We'll just keep hitting it and go lower. Okay. That's the bad news. So let's get rid of the moving averages. The blue is the 200 and the red is the 50. The rest are just short term. But I generally don't like to look at these. Okay, I like to have a cleaner chart. Okay, so this is, again, in literally 3 weeks we're down like 10%. Today we recovered. Today is Friday. We recovered to be down maybe 8-9% for in a 3-week period. This is very, very bad. Okay. And it broke the uptrend of higher highs and higher lows. However, and of course, it cut through this support level because when you have liquidations happening, when brokers are just selling everything because people are heavily long, they got leveraged long here, levels don't matter. Okay, so that's what we had in the beginning of the week. Everything just capitulating. Okay, so technically, we broke down from this level, and we're below the 200. Okay, so technically it's a bad look. Okay, however, we don't just go by technicals. Okay, we look at the fundamentals. This is just a technical analysis so far. We've held these levels, and we are so oversold with sentiment so bad. Like the fear and greed index was always at 18. Okay, and on Friday it bumped up to 21, but we're still at extreme fear. Okay, and the if we look at another index that I like to look at is the AII survey. It came out on Thursday. And you can see that, again, massive bearish, 59%. So we were bearish for these whole 3 weeks, even starting the drop, very bearish. And extremely, the bulls are very, very low. This is like a very, very low figure. They don't keep the lows, but 19% bullish for 3 weeks in a row is extremely like bearish sentiment. Okay, so you have this 10% drop, extreme negative sensitivities. Extremely negative sentiment, not sensitivities, and a technical picture that has broken down. Okay, but however, you don't just use technicals. This is just the technicals tell you what happened in the past, not what's going to happen in the future. Okay, so based on this, we're looking very bad. However, we had a nice rebound on Friday, yet we're looking very bad technically with extremely oversold sentiment and positioning. A lot of puts being bought. Okay, so this is where we're at right now, technically speaking. So let's go to the macro picture. It's going to be very quick. Okay, today this whole week was a light macro week, except we had a couple of very important prints. The first one being the core inflation rate, okay, the CPI, which is the main inflation gauge. As you can see, month over month, it came in at 0.2, okay, but they were expecting 0.4%, 0.3%, and the previous one, as you can see, was 0.4%. This is a huge drop in inflation. Supports our narrative that rates are falling and going to go lower, okay, because unless you start printing money, I don't think we're going to see inflation, and we're not printing money right now, okay. Well, you know, deficits are still going to be high, so that's going to be supported. That's liquidity. But so far, rates and inflation, I should say, is coming down, and I think rates are going to come down with it. Okay. So the other piece of macro was the PPI, the producer price index, which is not the favorite gauge that we look at, but it shows you, like, look, negative 0.1% change month over month. Okay, we had that here too, but it's just showing you that the macro, the inflation picture is getting more and more in our favor. In other words, that we expect inflation to go down and drop, which is supportive of markets. So the inflation picture month over month is good for our narrative that we are still in a quote-unquote bull market, even though the technicals were against us. But we're still quote-unquote in a bull market with fundamentals supporting our view. Okay. The other macro piece of data that came out was the initial claims, okay? And they came out at 220,000 versus 222. So we're still in the low end. We're not ripping higher. This was worrisome, but then it came back down, so nothing to worry about. So all three pieces of relevant macro data, the core inflation rate, CPI, the PPI, and the initial claims, all in our favor, okay? So let's go back to the S&P 500. What is worthy of note is that in regular bull markets, going back, 2009, let's go to the 2000, the bull market in the 80s, the bull market in the early 2000s, the bull market from 2009 to 2020, all of those bull markets had an average drop in the market of around 10%. The median is about the same, about 10% too. So 10% drops in bull markets are common. And yet we have this right now, and we're acting like it's massively fearful, as if we were down like 20, 30%. So the fear is much more overblown than the actual regular 10% drop, okay? And even though we broke these higher lows, we haven't broken this one or this one. Okay, so we're still a series of higher lows. The recent ones maybe not. So even though it looks bad, like this one looked very bad too because it broke a lot, it still ended up being bullish in the as time continued. Okay, so I am still expecting a huge bounce back, a huge short squeeze due to all of these factors: extreme pessimism, technical breakdowns. Everybody thinks everything is bad. Everybody's positioned negatively. So people who just look at the technicals are like wanting to go short. Everybody's waiting for the rebound to the 200-day moving average here, which is like at 572 on the SPY, so they can start shorting it again. This is the mentality right now. We've switched from a bull market mentality to a bear market mentality. And I think that's what's going to come back to bite people in the butt, because we're still in a bull market. Okay? We're still in a bull market. We haven't really destroyed anything. And this is a 10% drop, which is regular. Now, if it does go up and goes down, okay. I mean, the consensus trade will have won out, which is very rare. Because when you usually have to punish the people who are short at these levels. Okay, so I'm expecting at least a bounce to the 200 and probably even higher. Okay, maybe to the 585 level on the SPY. So there's no need to panic on a 10% drop when in reality it's just a normal median or average drop in a bull market, okay? And we haven't had that in a while. And this is the first time that we actually touched the 200-day, touched and went right through it like a knife through butter, this entire bull run. This entire bull run, we never went through the 200. Okay, I'll show you again. Never touched it after this bull run. From the bottom of December 2023, November, October, December 2023 to now, never touched it. Usually we touch it. I thought we would touch it in August here, but we didn't. This is the first time, and we didn't even touch it. We just blasted right through it because, like I said, when you have to liquidate, levels don't matter, so just blasted right through it. Okay, so again, my view is that we are going to have a vicious snapback rally still, and what to look for that to happen is when we keep getting bad news. We keep getting news about the tariff front, about whatever. Maybe there's a new war starting, who knows. But whenever there's bad news, we want to see that bad news hit the market and then the market go up. Okay? That is a sign that the sellers and the negative news is having no effect on the market anymore. People are already massively short, and then you're going to get a huge rally. Huge. It'll like knock your socks off. We get 5% in a week, maybe more. Okay? It's very possible that could happen, especially when everybody's cut off sides. All the technicals say bearish, like the short-term technicals. People are ignoring the fundamental picture, which is not devastating. We're not super hurt, as you saw from the macro that we just shared. The initial claims are not going through the roof. We're not in a recession yet. They're forecasting one. Everybody's forecasting one, but as of yet, we don't have that. Okay, and this is all a tariff war fear-driven drop. Okay, it got everybody to get out of their longs and actually initiate short positions, which is great. You want to see that in a technical bull market. You want to see people getting short as it's going up. It's not a lot of people, even bulls. Not a lot of people make money in bull markets except these like passive investors. But a lot of people get shaken out, especially on these fear-driven moves here. Okay. So what is the big picture? We talked about it's the tariffs that are driving this. And we talked about the big picture of a 10% drop is normal in a bull market. So I just want to put things in perspective. Okay, right now what we are looking for, what we are looking for is for the market to rebound on bad news, and keep the perspective that this is just a normal drop, and yet people are panicking a lot, and you can tell from the volume at the bottom. Look at this. The volume is still massively high this entire week. Okay, a lot of people sold out here. Okay, a lot. This is good for if you're a bull, which I still am. Okay, so I'm expecting a huge snapback rally to happen. Okay, so that's my overall view for the week. So let's just see one of my favorite sectors, one of my favorite performers to date. That is gold. Okay, gold, honey badger, doesn't give a crap. Okay, as the markets were tanking, gold barely fell. It was being liquidated to satisfy the short position, the leveraged long positions that had to come up with liquidity quickly, but it barely fell. It went from like 29.50 to 28.50. That's nothing. Okay, and then quickly rebounded, maintained the highs, and then this week, look, this whole week it was ripping. Maybe on Monday it went down, but the entire week was ripping. Gone to new highs and at the magic 3,000 level, which is here. It touched it today, went over it, and then gave it back. Okay, this is today's candle. Touched it, you can see the wick, touched it, and then came back down. So I am extremely bullish gold. However, we're at the magical 3,000 level. It's supposed to serve as resistance. Technically, it's not really resistance because there's nothing there. It's once you break it to new highs, it's nothing but air here. Look, we can go. There's nothing there. These are rarefied. We're in the stratosphere here when it comes to gold. Okay, because the fundamentals are great for it. The tariff war loves gold. Okay, or gold, I should say, loves the tariff war, not vice versa. So I'm really bullish gold, but underneath the hood is the gold miners themselves. Okay, look at that. Last week we looked at the miners in isolation and in connection in relation to the market and gold. Okay, we mentioned last week that this is like a cup and handle formation, and this should be the pivot point, around the 4250. And this week, which is around here, what is the Monday? There it is. So the whole week, miners were bid. Maybe down on Monday, but then the whole, you can see it clearer here. That was this red candle is Monday, then boom, the whole week up. So the pivot here on a cup and handle was taken if you're a technician, and this is where you should be long. So not only is gold going up, the miners starting to come alive. However, look at it in perspective. Okay, if you back up the perspective, miners are way below this 66 level that it hit in the highs of 2011. Okay, we had that cup and handle, or this big cup and handle if you want, and we need to break above 45.50. I think we have a long way to go to get to 66. So you have gold at all-time highs, but not the miners. However, for 2025, which is around here, they started out around 33, the GDX, and now it's at 43. That's like a 33% return in 2025 alone. But like if you look at GDX versus the metal GLD, it's not doing well because gold is at all-time highs and the miners are not. However, that's the overall picture. But if you look at recently, look, in all of 2025, it's been outperforming gold, believe it or not. This is since January of 2025, which is that little area right here. It's been outperforming gold. Yes, it made a little comeback, but now it's back up. So for all of 2025, it doesn't look like it, but the miners are outperforming the metal. And how are they doing now versus the regular market, the S&P 500? Ripping. 2025 starts here again, and versus the market, they are up a lot. A lot, maybe 30%, a 30% outperformance versus the market. That's huge. But remember, historically speaking, the market has been doing much better, right? Look at the peaks. And so this is a nothing move. 2025, the outperformance of GDX or the miners versus the market in 2025 is nothing compared to historical moves. Look at these historical moves. Look at this area right here. Look at these areas right here. 2016, I remember 2016. Massive outperformance for the whole year, even into the summer, into August, from January to August. Not even close. What is it? Not even a third of the move of the 2016 move. Okay? So look forward to the metals, or should say, the miners outperforming S&P 500 going forward. Because right now, the picture of the gold miners are much better than they were in this 2016 move in terms of their balance sheets and the printing of free cash flow, way better. The management of gold of the majors has learned a huge lesson, okay? And they are much better off than they were back then. So I don't know what's going on, but if you're a portfolio manager and you're not allocated into the gold miner space and the gold miners, I don't think you're doing your job. You should have at least a 5% allocation, not a 0% allocation, a something percent allocation at the bare minimum. Most portfolio managers have 0% in gold in the gold space. Okay? So the GDX now, the miners are starting to outperform not only the metal, but outperform the S&P 500, and nobody cares about it. S&P 500 is a different story. Okay, GDX divided by the SPY. It's a different story. The miners are massively outperforming the general equity space. Okay, so now that we talked about the miners, what about silver and gold? What about silver? This is silver again. We'll put another one here. It's a mirror image to gold in terms of the short term, but not the long term. Look, the whole week silver was bid. We were talking about it around here. Well, actually, we're talking about it as it was going up. But look at this, getting ready to break out to new highs, a series of higher lows. This is a high. It has to break this high. Okay. In fact, let's mark it. Let's mark this high for future reference. Okay. But if you look at silver, you go back, silver was much higher, was $50, okay? because right now silver is around 33.70, but this is the previous spike peak. And look, when silver gets going, it goes fast. Breakout, fast. Okay, this one, but that's 2020. Okay, when silver gets going, it can go fast. So we have silver here outperforming. What about silver versus the S&P 500? That too has been outperforming. Everybody's talking about gold, but nobody's talking about how silver is also outperforming the S&P 500 in 2020. The 2025 is right here. This is the beginning of 2025. It too has been outperforming the S&P 500. So this is the most stealth outperformance I've ever seen in my life. Nobody's talking about it. Okay, that's why you should be allocated in the precious metal space. It's not. It shouldn't be everything, a big chunk of your portfolio. But if these PMs start investing in this space, even just 1%, 2%, 3%, it's so small that it's going to rip. It's not big enough to sustain all that demand. So this space is going to rip if you have these PMs getting back into it, which it looks like they are. GDX is starting to outperform again. Okay, and the last thing that I want to mention this week is Bitcoin. As you guys know, I started getting long here because it was holding up, but then the market trade wars tanked it. This is this week. This week, Bitcoin is up the whole week, outperforming the SPY this week. Okay, this is Monday. So this whole week, Bitcoin was up, whereas SPY, if you recall, this whole week down and then just Friday went up. Bitcoin is up here, relatively speaking. Like the market should be up here if it was to be on par with Bitcoin this week. So back to Bitcoin. My strategy is going forward is that I'm already long. Like if you went long March call options, if it gets up to this space next week, because they expire next Friday, OPEX, I'd get out. Okay, because try to get out at break even or trying to minimize your loss if you have March calls on Bitcoin. Okay, but if you have April or more, you should try to let it ride a bit. Okay, because even MicroStrategy rebounded this week. Okay, and it could go a lot. Like this Friday's move on MicroStrategy is 13%. Like this thing, if Bitcoin starts going, this thing could be up here to the 390s, 400 level fast. Okay, this has leverage. Leverage on the way down, but leverage on the way up too. Okay, so the Bitcoin strategy going forward is that if you're short-term dated, get out here. If you're longer term, you can hold on to it. Okay, maybe get out half at break even and hold the rest. Okay, because this technical breakout, I thought it would recover and it did, but then the tariff war just bleeded it dry. And if the S&P 500 goes up in a snapback rally, a short squeeze from hell is what I'm expecting, this should do the same thing, if not more. Okay, so that is my outlook on Bitcoin. Sell some here quickly if it gets to this level, because it could be a retest before it goes down. But if you're short dated, get out, minimize your loss here. Okay, if you're longer dated, you can get out half here and then hold the rest, which is what I intend to do. So my conclusion going forward is that I'm still bullish, even though we had the 10% drop. It's a normal drop. I will change my mind when we hit it and start going over. We hit some kind of key levels and start dropping. I will start changing my mind. But from now on, I expect a huge snapback rally, especially given this extreme sentiment it has to play out. And I'm expecting this fear and greed index to go at least to the neutral. This is where I'm going to start selling some of my positions. Okay, because I don't think, like if the trade, any piece of good, we are so positioned to the negative that any piece of good news rips this market. Okay, and if it does rip this market to here, people are still not going to go long here. They have a negative mentality right now, thanks to the technical setup of breaking down some levels, especially this one, and everybody looks at it, the 200-day moving average. We need to recover above this before people will start piling on. I know a lot of hedge funds that whose main strategy is now they just buy the S&P 500, and now they're technically at their lowest level in the S&P 500 because it broke below the 200. If it's above the 200, then they're going to start piling on again. Okay, everything is based. The strategy is based around the S&P 500. So here they might be above the S&P 500, above the 200-day moving average. They're probably like 80% allocated, and here they just sold everything and are 20% allocated. They're waiting for it to go back up to get 80% allocated again and ride it. These are very simple strategies, but they are being played by big money, okay? So right now, I know everybody's looking to short a pullback to the 200. Okay? The 200-day moving average is key in a lot of strategies, okay? So right now, the technical picture is negative if you look at this. However, if you couple it with the overall bull market and the fear and greed indexes, or I should say the sentiment indices, whatever, I expect a huge snapback rally. That is my conclusion, and I look forward to seeing what happens next week, which is not only options expiry, but the Fed also meets. And another thing with the Fed, if it announces any kind of dovish talk right now, since inflation is really being mitigated, if it says, oh, it's exactly like we were hoping and we're going to probably cut rates sooner than we thought, boom, that will another light my another rocket ship higher. Okay, so the situation still remains. I'm expecting a huge snapback rally. Any piece of good news is more likely going to rip this market. Take care, and looking forward to next week.